Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we are back. The 21st episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, 21 of them. Do you remember your 21st birthday by any chance?
I do. Or maybe I kind of do, but I don't want to. So I'll leave it at that.
Understood. Yeah, I was at Xavier University, and I maybe had a few, and I felt a little bad the next day. But, when you're 21, you're 21. But we're really excited. We hit the 21st episode of Carson's Facts versus Feelings. Guys, we're going to call this one Fed Lasagna. Let Sonu kind of describe that. We got lots of different Fed opinions and lots of different things swirling out there. So we're going to dive into what the Fed has been saying lately, and also the CPI number, which just came out before we started recording. I'm going to take a look at that. We're also going to look into market sentiment. There are some wild views on market sentiment right now. Are we in a recession? Are we not in a recession? Is it a bear market? Is it not a bear market? We're going to dive into some interesting things we've seen the last week on that. And we're going to end things with a debt discussion. One of the top questions we hear from our partners. Look at all the debt. What does it mean? Sonu, you did some amazing work on that. And we're going to talk about that soon. So again, Fed Lasagna. Just first off, when you say that, do you get hungry? And what do you mean by that, Sonu?
No, I'm not a huge fan of lasagna, especially frozen lasagna. I don't think I've ever bought a tray. Is that what you call it? A tray of frozen lasagna, Ryan?
Sure.
No offense to anyone who buys it, but I don't think it's.
Yeah. So you didn't grow up eating Stouffer's, that big thing of Stouffer's lasagna for like $10 that would feed 20 different people.
Except it's not $10 now. Apparently, it's $21. So says Neil Kashkari of the head of the Minneapolis Federal Reserve. So he was the one who said, you know what? I pay attention to grocery prices. There's this large tray of lasagna that I used to buy that cost $16, Ryan, not 10 anymore. Now it's $21, and that's my own little measuring stick of how inflation is going. So there you go. The Fed's following lasagna prices.
Wow, they follow a lot of different things. But let's talk about that. I mean, clearly the Fed is led by Jerome Powell, but there are different voting members, there are non-voting members. There's a quiet period before a Fed interest rate decision, where they don't talk. But it feels to me, Sonu, where we're hearing more and more from various members. Sometimes I didn't even know who the person was, and they're on CNBC moving markets. I mean, what have you found the last couple of weeks with this Fed lasagna, all these different opinions that are out there, what the Fed should or shouldn't do?
I think the general theme is, we definitely, last couple of weeks, definitely not the quiet period, because we had everyone coming out of the woodwork and giving their opinions. And it's good, right? We talked about, historically, even 30, 40 years back. I mean, I say even 30, 40 years back, that's a long time away. But, you had to look at markets to figure out what the Fed did at the last FOMC meeting. There's no forward guidance. Nobody's giving speeches. If Greenspan gave a speech, you couldn't understand what he was saying anyway. So right now, everybody's talking about their views. And I think just the general theme from last week, everything we've heard, was they want to keep rates higher for longer because they think inflation's not going down as fast as they like back to their target.
No, exactly. And you and I talked last week about the more than 500,000 jobs created last month, way more than expected. See some different economists. And we'll talk more about the economy kind of in the middle of today's podcast. But other people say, hey, we could get some really good data. Excuse me. I get so choked up talking about this. We could get some really good data in January thanks to some of the better weather that we've seen. Now, just some of the things I scribbled to myself here. Williams from the Fed recently said there's more work to do. Waller said higher for longer. Kashkari, he said more work to do, and 5.4% terminal rate. I guess the bottom line is the Fed continues to be hawkish, and okay, that's one thing, but look at what rates did last week. We saw a big jump in yields across the curve. Bonds had a rough go of it just last week. I mean, maybe the market's buying it, the higher for longer thing. What do you think?
I think the market's buying higher for longer, mostly because the economy is doing better than anyone expected. I should say I think we've talked about the economy being stronger than than everyone's predicting and everyone's predicting recessions too, right? And that's not been our outlook. We haven't, you said we think the economy can avoid a recession, right? So I think markets are coming out, around to that. And if that's the situation, you think bond yields should go up, right? If the economy is doing fairly well. I mean, if an economy is going into a recession, yes, bond yields should be lower. So that's the way I think I'd look at it.
I'll tell you, it's interesting because, we heard before, the economy's weak. We're going into a recession and that's going to be a bad thing. Just now, over the past couple of days, so we're hearing, you know what? The economy might avoid a recession, meaning the Fed has to be a little more hawkish, meaning it increases the chances of a Fed policy mistake. And that's what we should be worried about now. Right. I mean, it just seems like, believe me, you always should be worried about something. We're not laughing at this necessarily, but my goodness, it just seems like 180, and now we're still worried about something. But my take is this: I'll put a bow on this. I don't think I don't think a strong economy is a bad thing. Historically, the Fed hiking a little bit is not always a bad thing. Markets tend to do okay when the Fed's hiking. I mean, I don't know. Well, what do you think about that? It shocks me at how people are now saying, a strong economy is bad, whereas a recession was bad 3 weeks ago.
Yeah, no, previously it was like, we're going to get a hard landing. Now it's like people have changed their views to, maybe the plane is not landing, looking for a runway yet. But that means, there will be a soft or a hard landing later down the road. Of course, the plane's always got to land, right? Come on. What are you talking about here at this point?
Eventually it'll run out of gas, I guess. I mean, just some notes, just some things I've seen. Bank of America CEO came out recently, said companies are fine. Spending remains strong. Wells Fargo has said the bear market's over. No landing is what their economist is calling it. Kind of similar to what you were saying. There's no need to even look for a runway yet. Goldman Sachs CEO, better chances of a soft landing, and the consumer remains resilient. I might keep going. I mean, the other one that got me was it was Starbucks and Chipotle. They said that, listen, we don't see a recession. I go to those a lot with my kids. They don't look very... They're recession proof or something there. People are spending money, but they also said they can do the data and they're high income spenders. And a lot of people that go to those honestly, they're actually spending more. All right. So again, a lot of ways to look at this, Sonu, but it doesn't feel like a recession to me. I know you feel that way also. Others are coming around. Do you see that?
No, exactly. And where it shows up, the other side of that, and we just talked about the Fed keeping, the other side of that is obviously the Fed keeping rates higher for longer. We're thinking about why they do so. Inflation, right? We just got inflation numbers, right? This morning. We're recording this on Tuesday, February 14th. By the way, happy Valentine's Day. Ryan, are you doing anything special? Is this?
Wow, I can't believe I didn't even mention it's Valentine's Day. I'm up in Springfield, Ohio, where my mom lives. Going to hang out with her a little bit. She's been under the weather a little bit, so gonna see her and then go back home. I think we've got just practices and standard things tonight in the Detrick household. But what about you guys? Anything? Do you have lasagna by chance?
No lasagna, but we do a cheese and chocolate fondue on Valentine's Day Eve. That's the tradition with the kids now. So their eyes, it's worth just seeing their eyes when they see a big bowl of chocolate they can dip, pound cake and strawberries and bananas into.
Now, full disclosure, is that really for the kids, Sonu? I mean, really?
No. We partake too. So there you go. Yep. But inflation, shall we talk about this morning's inflation numbers?
I'll set the stage and then hand it to you because y'all got a chance to look. CPI, 7 months in a row now. Year-over-year CPI came in lower than expected. The headline number, though, I believe it was 6.4, Sonu. I believe it was a tad higher than what some economists were expecting, but the trend remains low. You had about, maybe 30 minutes to dive in, not a ton of time, but your initial reaction to the CPI print, what are you thinking here?
So two things, right? One is it's not as bad as last year. And the very fact that everything kind of came along expectations means that, people are getting used to what the CPI is doing, which is a very good thing. There are no big surprises, right? That's what we want. Now, if you think back over the last year, the headline was always like, strong. And then we used to look at the underlying detail and say, hey, it's this thing going up, it's that thing going down. What's interesting with this report is that the headline is, the trend is continuing. It's down, right? Not as, it's not as strong of a downtrend as we'd like, or the Fed would like, obviously, but it's coming down, right? Both core inflation excluding food and energy, but even headline inflation. But you now look at the underlying details. Here's my story. Like with all these data points, you need a story, right? What's the story?
Sure.
What's the data telling you, right? Sometimes it doesn't tell you a story. It's just random. Random stuff happens with the data, right? But I think there's a pretty clear story. The story is the inflation data shows a strong economy. That we just talked about that. You think about this, right? If you have a hard economy and consumers are spending, as you just said, what do you expect you expect prices of certain goods to go up, right? One example is restaurant food prices, right? That was up last month, right? We're not seeing, you're saying used car prices come down, which is good, but the rest of core goods, right? That disinflation, we've been talking about that for a while. That disinflation hasn't kicked in yet. Talk about housing activity crashing, but household furnishing, that's up. This little category called tools and hardware, that's up. Apparel, people are buying more clothes. That's up 0.8% just last month. And this is across the board. Men's, boys, women's, girls, all of it, right? Yeah. And then you take hotel prices, that's up, right? Pet services, that's up. Daycare, preschool, that's up. Laundry, dry cleaning, I can go down the list. It's all up. So all things you think about, right? Oh yeah, if you have a strong economy, you'd expect price pressures in these areas. Of course, now the Fed's looking at it and think, yeah, we got to keep rates higher for long.
Yeah, I almost feel guilty. I think the tools being higher was me. So we moved recently. I lost them all. I'm telling you, man, I've looked at every box. I can't find any of my drills and screwdrivers. Now, believe me, I'm not the handiest person at all, but I had to go buy some more recently. So maybe I'm doing that. So along the lines of the economy, Bank of America looked at their data. So this is just Bank of America credit cards, up 5.1% year over year ending January, from up 2.2% ending December. And here's what's interesting. So the consumer looks really strong. Yes, maybe people are buying post-holiday season deals. Here's something they pointed out, Sonu, and it reminded me of something you've been saying. They said one of the reasons consumer was stronger last month, Social Security up 8.7%, and minimum wage in nearly half the states, United States, just jumped in January also. Those are two things we've talked about. I mean, we're seeing it already. Do you believe it?
Absolutely. I think, anytime you get a jump, Americans are not known for saving money, right? Let's make that clear. I mean, the rest of the world banks on that fact, right? Everyone's dependent on the American consumer. Everyone's dependent on the American consumer continuing to earn and spend and save. Not a lot, right? So I think, Social Security went up, and maybe it's seniors buying tools and hardware and apparel for their grandkids and stuff like that. So.
There you go. So that was our Fed lasagna discussion, sprinkling in some inflation. We wanted to spend a lot of time on that. We're going to take a look at kind of market sentiment and economic sentiment and economist sentiment here soon. But before I do that, Sonu, let's talk about the Super Bowl for a second. We playfully mentioned the Super Bowl indicator last week. Plain and simple, don't invest in this at all. But when the NFC wins, stocks do a little better. Well, Kansas City Chiefs won a somewhat controversial game with a holding or a pass interference call that maybe or maybe not. And as a Bengals fan, I'll just say this. Look familiar because it was less than 2 minutes to go. Last year, they had a phantom holding call against us, giving the Rams 4 more tries and scoring a touchdown versus a field goal, giving them the win. Not that I'm still salty or bitter, but anyway, we'll move forward. Enough on that. But here's one interesting thing. If you look at blowouts like we talked about last time, win by 21 points or more, stocks do better. Close Super Bowls, stocks do worse. This was a very close Super Bowl. But our friends at Bespoke did a study when you have more than 60 total points. This is the third highest scoring Super Bowl ever. Stocks actually do a lot better when it's a high scoring total game. So bottom line, don't invest in this. It's just kind of fun to talk about. But Sonu, halftime, Rihanna came out and introduced to the world she is pregnant. Where do you rank Rihanna? Or maybe not that. Well, maybe where do you rank Rihanna? Or did you like it or not like it is what I should say. But what's one of your favorite Super Bowl halftimes of all time?
I love the show. I thought it gave me a little vertigo to see her standing on those platforms and then finding out that she's pregnant. Like, oh my God. I was like, okay, that's something I couldn't do even if I'm in like peak form, even if I was say 21, right? Not climbing that thing and dancing.
Well, when you're 21, you might have had a few drinks to celebrate that birthday, and maybe then you'd have some vertigo on its own. But I digress.
No, it was great. She was a real boss lady out there. Like usually these Super Bowl shows have just one person, right? Or multiple people coming, and she just did the whole thing by herself. There were no guest appearances, things like that. And that takes me, I think my two favorite Super Bowl performances also like sort of solo. Prince, obviously. I mean, that was just phenomenal. And the other one is, Bruce Springsteen. right?
Mhm.
I think I was looking at a video the other day, just looking at some of these old, favorites. I think that was the one show where everyone's into it. Everyone's dancing. Everyone's,
Yeah.
waving their hands. I mean, everyone loves the boss, right? So
Yeah.
that was a great show.
I mean, I
What
think.
about you?
Well, yeah, I mean, I think you got to give it to Prince number one. I mean, literally during Purple Rain, it started to rain. Like you can't make that up, right? I mean, like that's like I really liked Bruno Mars. Now I like the Red Hot Chili Peppers, so Bruno Mars did bring out the Chili Peppers. I had a lot of high energy, a lot of excitement, but Rihanna did good. I'll tell you, I'm not a country fan. Chris Stapleton. Okay, I thought his rendition. I mean, of course, Whitney Houston's number one. I think with the Star Spangled Banner. What Stapleton did that might be number two. That was pretty cool. Man, we could talk on this stuff all day. But good game, little controversy. We'll see what happens. Congrats to the Chiefs. Rough one for the Eagles. I know what it feels like as a Bengals fan, but we're going to move forward. So to market sentiment. I mean, it's fascinating because we're starting to see some bulls coming in to a lot of the sentiment polls. By no means over the top bullishness, but it makes sense. We're having a really good year. The economy's stronger. I mentioned all those CEOs and different economists that are coming along to what we've been talking about for a good deal. But the one that I want to point out here, the AAII sentiment poll by Bears and Bulls comes out weekly. It had 44 straight weeks of more Bears than Bulls. Just last week, finally, more Bulls. And I see people on Twitter and FinTwit saying, oh my God, here we go. Everybody's bullish. This is the end. This is the end. I'll just go with this. Not so fast. Quote Lee Corso to keep the sports theme going. Not so fast, my friends. There was a 34-week streak that ended October of 2020. Okay, we just had 44 straight weeks. The second longest ever was 34, up 31% a year later. And the second longest streak ever was 22 weeks back ending December 1990. A year later, stocks up 30%. What I'm getting at, we have these long periods of bearishness, and then finally you start to see more bulls. It's normal, everyone, to have some bulls in a bull market, and that can continue. So I call it an unwinding of bearishness. It isn't just going to end. Now, believe me, second half of February historically is kind of weak. Wouldn't be shocked after the start of this year. Maybe markets consolidate, perfectly normal. In fact, I might not be. In fact, I probably like that, to be honest. But looking out, this unwind of the bearishness, Sonu, can last a lot longer than most people think when you look back at history. What have you noticed? Looking at, maybe let's with you focus on macro. Just people catching on to what you've been saying for 2 months now, right? You noticing that?
I think so. Something you said struck me. I thought it was funny.
Oh,
but
boy.
so
was it the halftime quote or lasagna?
No,
what was it?
No. It's like, look, by definition, you cannot have a bull market without bulls, right? I mean, just by definition, it wouldn't be a bull market without bulls. So you go. But no, look, I think one thing, I've been looking at this, which is interesting. So the rally, I mean, you've called this, before as well. Like we thought the low for the S&P 500 is October 12th. And so you take October 12th through to, this week. So let's say 4 months out. It kind of neatly fits into two halves, what I call like a tale of two rallies. What happened, initially in the first, couple of months from October, November, December, was you had the stuff that did well, like the bear market winners, energy, things like that. Those continue to do well, right? Everything sort of rallied, obviously. You want to see that. Now, this year has been all the, dare I say, trash, right? Everything that just tanked 60, 70%, that's up a lot, right? The other thing is, look, if you're a $100 stock, you go down 80%, right? You're going from 100 to 20. Even if you gain 50%, you're back only at $30, right? You're still down 70%, right? So there's a long way to go for this stuff. And that gets to your point about you're not quite done with this rally yet, right? There's a lot of room to go.
Yeah, I think so. Obviously, is what we've been saying for a while now, and things have been working. So we'll keep following it. CEO confidence was up 11 points in the first quarter, big jump. Now, believe me, CEOs are still quite dour on things. Here's what got me: 98% of CEOs last quarter expected a recession in the next 12 to 18 months, down to 93% of CEOs expect a recession. So that's still the common call that we're seeing.
Can I ask a question? Can I ask you a question on that? Are CEOs ever positive on the economy? I mean, they're very positive on their own companies, right? And their own abilities, I should say. I'm trying to think about a time when a whole bunch of CEOs, this is a fantastic economy.
Yeah. I'll tell you, I'm with you. At least the last several years, no, is the short answer, right? Of course, you're talking your book. You always
Right.
got to kind of lowball it. That's kind of what we've seen throughout history when it comes to earnings and estimates
Yeah.
and things. But I'm with you that I think a lot of them
I
have
just
the
think it's
glass
funny.
half empty type of mentality. Even if they don't mean it, it's just kind of what they're outwardly saying. But good point there. There's a recent Gallup poll. This is looking at just consumers. Only 50% of American families are better off financially than a year ago. Okay, so again, that's a low number, by the way. I mean, that's a lot of people are worried, or I should say, it's a high number. Because they're worse off. So that number is high is bad. So a lot of people are worried about their financial situation. Not overly surprising when we see that. But then again, you look at the spending that's out there, and you do see kind of two sides to it. It's very unique. And then just various other sentiment polls are showing more optimism. Well, I've got one. I wrote it here. Just one of my favorites, the Bank of America Global Fund Manager Survey. We'll end with this one. This is real managers managing real money. Okay. A little bit of pessimism here, which from the contrarian point of view, I like. 2/3 of the people that were polled in this recent one came out like today, say that it's just a bear market rally since October, not the start of a new bull market. We've been a record saying it's a start of a new bull market. A lot of people don't feel that way. Investors are still a net 31% underweight equities. It's higher than it was, sure, but still 31% underweight. The allocation to the U.S. versus the rest of the world is still near like decade lows. And here's the last one. The odds of a recession, though, the next 12 months, Sonu, only 24%, was 77% in November. I'm going to go to you now. Wow. It feels like people are saying, you know what? The economy's better, but we're not more optimistic about stocks. I don't know. It doesn't make a lot of sense to me. What do you think?
Yeah, it goes back to what we started with, right? Oh, the economy is strong now, which means, it will be less strong later. Like,
yeah.
I mean, come on. I think everyone's coming in. Look at the data, but we saw it last, couple of months ago, dare I say, when we were writing an outlook, right? Mm-hmm. So it was 3 months ago or so. It feels like
it feels like a lifetime ago, but I think it was only 3 months ago.
Yes. But yeah, no, we were talking about inflation trending lower, so real incomes are going up, and so that's good for consumption. At the back, second half of this year, I think the global economy will start to pick back up. That's going to be good for U.S. manufacturers and exporters. So housing is hopefully finding a floor, right? Mm-hmm. I mean, look at household furnishings, right? Like that would be prices for that wouldn't be going up if housing activity was tanking, right?
Right.
So just by that itself, look at it, right? So I think we saw growth accelerating. I mean, going into the first half of this year. I think everyone else is seeing that now.
Exactly. And just from a purely markets point of view, we've pointed this out before, the first and second quarters of a midterm year where we are right now, pre-election year, apologies, pre-election year, we are right now, the first quarter and second quarter are like the two strongest out of 16 quarters. Now, and we're throwing a lot of things out, and all you focus on is that, but just all the bearishness that we saw late last year with an economy that's going to avoid a recession, according to the awesome work you've done for several months now. So, you know what, we could have a surprise first half rally when everybody and their mother was saying bad first half for the stock market, better second half. Kind of funny how that plays out. So we've got about 5 minutes, and we wanted to talk about debt because it's a top question we keep getting from our partners, our advisors, and our clients about all the debt that's out there. But before I go there, I did learn something over the past week. NORAD is not just something that you use to track Santa Claus the night of the Christmas Eve. The NORAD stands for North American Aerospace Defense Command. It actually, they're shooting down literally they're shooting down UFOs. And at the time we're recording this, the government has even said they're not sure how some of these things were powered. I don't want to get too conspiracy theory here, but I mean, from an investment point of view, we have had this question. Should we be overly concerned about, we don't know what's in the air, but we're shooting stuff down?
Did they? I'm like, did they turn up the sensitivity of their radars just last week, and then suddenly they saw all these, objects flying? Yeah. I mean, you have a couple of few older kids, right, Ryan? Hopefully, they don't have any drones going up in the air that the Air Force shoots down. So
yeah,
keep an eye out on that.
I'd be furious. They don't have a drone. I know they're not cheap. If they got a drone shot down, I'd be very mad at my kids, along with the government being mad at them. But,
So speaking of the government. Shall we talk about debt?
Let's
government debt.
let's go to the final thing. Debt, $31.4 trillion. We're going to keep kicking the can, likely increasing the debt ceiling. But Sonu, you did amazing work for our partners last week and this week that took a look at debt in a way that I honestly hadn't seen before. What did you find, and how worried should we be about the trillions of dollars of debt our country has?
Right. And this gets to something we put in our outlook too, right? Because remember, one big concern right now is, consumer credit card debt is going up, right? Well, of course. I mean, as prices go up, credit card debt will go up. The question is, can consumers service that debt? And what we wrote was, yes, they can. I mean, debt service cost was really, close to the lows we've seen historically, right? Which gets to, how high, this is a question I got from a colleague, right? How high would the terminal rate have to go to reach for U.S. debt service to become unmanageable, right? Shout out to Kate Hall, which is a fantastic colleague over here on the Carson investment research team. So that was her question. And she was like, do you have an opinion on that? I was like, yes, I do have an opinion. So look, you have to consider, how debt service costs, right? Can the government afford to pay back the debt? And we're really talking about interest costs, right? So if interest rates rise, of course, interest costs are going to explode. That's literally what we've seen. The line literally goes vertical, right? But you have to think, what matters is the government's ability to service that debt. What are they servicing it with? Tax receipts, right? Now look at the chart of tax receipts. That's exploded up as well, right? And now what's interesting here is that rising employment helps, right? Because as more people employed, there's more going back in taxes to the government, right? Because people are earning more as, total income. So now if you take the divide one by the other, interest cost for the government divided by tax receipts, that doesn't look as scary. In fact, that's below the historical average right now, right? It's going up a little bit, but right now, it's about 23% or so. Back in the 80s, remember when Volcker raised rates a lot and we got a recession. So we had two things. Interest rates are going up and we had a recession. So there was less income to be taxed in the economy. So debt service ratios exploded to about close to about 35%, right? We are nowhere close to that right now. So I think just a framework to think about, yes, debt service costs are going up, but tax receipts are going up too. So it's not a bad thing.
Yeah, that's an easy way. We know a lot of advisors listen to this very podcast. That's an easy way to describe what's going on. So you're going to probably put a blog together fairly soon as well to kind of share and show a lot of the things you talked about. The other one we talked about, you hinted at it here, just household debt service payments as a percent of disposable income, updated quarterly. Most recent quarter, 9.75%. It was 9.75% exactly pre-COVID as well, and it was as high as 13% back in 2006, 2007. So again, yes, there's more debt out there, more credit card debt, but again, how much we're paying on it, and people are actually worth more. I call it denominator blindness. We all know about the numerator.
Yes.
You got to take a look at the denominator, and the denominator in a lot of cases has been growing as well, like you mentioned, with tax receipts also going higher, so the government can help fund a lot of this overall debt. Did I say that correctly, Sonu?
No, absolutely. I love that term, denominator blindness. That's a great term.
You can use it a lot, but when it comes to debt, I think we use it. And again, we're not minimizing. I'm not a fan of $31.4 trillion worth of debt and likely going to expand it, right? I think you should pay the bills you have. I'm not saying that, but what we are saying is we've had a lot of debt issues in our country for a long time, and it's not always so clear cut. And by itself, it's not always just this wildly bearish thing. It can be eventually, and we're aware of that, but there are a lot more positives that are out there in our opinion. All right, Sonu, so we have hit the end of the road in the 21st episode of Carson's Facts versus Feelings, Fed Lasagna. I don't know, any final comments from you on the Super Bowl or UFOs or anything else that all bring us home?
UFOs. I may be literally a finding, definitionally, like unidentified flying objects. Right?
Yeah.
The Air Forces, at least. And we're shooting it down now. I mean, what's interesting is that I don't think the U.S. is technically allowed to or is supposed to be shooting things over American airspace unless there's a war or something. So there's a whole thing about that, but I don't know.
I don't know. I mean, I guess we better go watch the movie Independence Day and brush up on what we can and can't do, but let's hope that's not the case. I made a joke that and this is a joke again, historically when Philadelphia has won a World Series or a Super Bowl, bad things have happened. Panic of 1910, 1911, 1929 stock market crash, 1930 Great Depression, World War I was right around the corner in the mid-19 teens. What else we have? We had early 80s double dip recession. Philadelphia won a World Series. 2008, Philadelphia won a World Series. 2018, the Eagles won the Super Bowl. It's the worst year for stocks in 10 years. Maybe we should be grateful that the Eagles didn't win to add something really crazy to what would be coming after that, as his history has told us many times before. But guys, with that,
dodge the bullet there.
Hopefully playful ending there. Don't invest in that stuff. But what you can invest in is we will continue to do this podcast, our 21st episode of the Carson's Facts versus Feeling podcast with Ryan and Sonu. We have a blast doing it. You keep listening. We'll keep doing it. Everyone have a great week. We're on with Ed. Ed, what's Ed's last name? This one blank. Ed Davis. Sorry, Ed. Ed Clissold from Ned Davis is going to join us next week. It's going to be an awesome discussion. Ned does amazing work. Sonu and I are both huge fans of Ned Davis research and also Ed's work. So that'll be a really fun podcast next week. We'll see everyone then. 21st episode is officially in the books. Take care, everyone. Bye-bye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.